Ladies and gentlemen, we'd like to get started. My name is Ryan Ratcliffe. I'm from the Economics Department here at USD, and it is my pleasure to welcome you to the Global Outlook 2010, sponsored by the Ahlers Center for International Business here at USD, as well as the Economics Intelligence Unit. I'd like to give a quick thanks to both Chair Jankowski from here at the Ahlers Center and Josh Hill from Field Marketing at the EIU for making this event possible. I think this is a fabulous event for the USD community and the San Diego community at large to have such a distinguished speaker come and tell us about the international economy. The Economics Intelligence Unit has been a great partner for us here at USD. This is the third time that they have brought one of their editors to campus to share their ideas with both the university community and the local business community. They also support us in a number of ways that I really appreciate, both as a researcher and a teacher. Their informations products span the gamut from just the I'm curious about a company or about a country, and I have very little idea what the political and economic climate is. They've got cliff notes for that, all the way for the I need to know what GDP in this country was 10 years ago, quarterly, broken out by industry. They've got data on that too, and everything in between. And if they don't have it prepackaged, they're very willing to help you come up with a custom data solution. So they've been a great partner for us, and if you're not familiar with them, I encourage you. They're a great, great resource to get familiar with. There we go. Okay, so it's my privilege to introduce our speaker. Leila Butt is a senior editor and senior economist with the Economist Intelligence Unit. She specializes in political and economic developments in Eastern Europe with a focus on the Czech Republic and Hungary. She's also the deputy manager of the EIU's Country Risk Service, which produces regular analysis and ratings for sovereign risk in 100 different countries around the world. She holds a bachelor's degree and a master's degree in economics from the London School of Economics. So it's my privilege to introduce to you Leila Butt.
Thanks for the introduction, Ryan, and thank you for having me here today. Can everyone hear me okay? Perfect. So I'm going to be talking about the prospects for the global economy over the next couple of years. I'm going to sort of lay out what developments have been over the past few months, and then focus on the developed world and then the emerging world, and then end with discussing some of the risks to our baseline forecast. So briefly, sort of data over the last few months all point to a recovery in every country in the world, more or less. But it's going to be a multi-speed recovery. For example, Asia is going to be the leader in terms of growth out of all the emerging market regions, and that's going to be led by growth in China and India. In the developed world, the US is expected to outperform other developed regions such as the EU and Japan. Now, the recovery has been sort of based on huge fiscal and stimulus packages implemented by more or less every country in the world, particularly in Europe, Japan, the US, and then some of the Asian economies. A monetary loosening as well has helped to avert a Great Depression. So a worst-case scenario has been averted. But the recovery is going to be quite muted. It's a largely jobless recovery, and banks remain stressed. In addition, attention is now focused from financial sector risk to sovereign risk, as the stimulus packages have led to a very large surge in public debt everywhere, but again, particularly in the developed world. And we remain worried about what could happen over the next few years, particularly as one-off stimulus measures begin to wane and then are completely ended. But anyway, things are looking much, much rosier than they did at the beginning of last year. On the corporate side, businesses are looking much more optimistic. The chart here shows the Purchasing Managers Index, for the Eurozone, the US, and China. And basically a value of 50 or above shows that companies expect an expansion or an economic recovery. So you can see that from the trough that it reached around the end of December 2008, the Purchasing Managers' Index is actually rising to above 50. So business confidence is really, really much better, and companies are actually beginning to invest and increase output. Consumers, too, are feeling better. Retail sales growth, again, like the PMI index, is looking much, much better. So again, following a deep trough at the onset of the intensification of the global financial and economic crisis, retail sales are again beginning to grow quite strongly. However, it's important to understand that most of it is being driven by government stimulus packages. For example, the US fiscal stimulus package was equivalent to about $800 billion last year. A further $150 billion is being spent this year. Monetary policy has been very, very expansionary. Interest rates are at record lows. And banks around the globe have resorted to unorthodox monetary policy, such as quantitative easing, in order to ease financial stress and stimulate investment. So most of the growth is being driven by these stimulus measures, which are likely to come to an end this year. And that's because governments really don't have enough room to further expand policy. So that's going to act as a dampener on growth, because private demand really is very, very weak at the moment. And in the US and the UK in particular, there's this fundamental balance sheet adjustment that is underway when it comes to the private consumer, because they're severely overburdened by debt. In addition, much of the recovery on the corporate side is due to restocking. Now, last year, the recession was really primarily, or to a large extent, driven by destocking as companies ran down stocks because they just felt that it wasn't good for them to invest in capacity enhancement or to actually grow output, because nobody was actually very sure about what was going to happen to the global economy. So everything is being driven by these one-off measures, and the issue is, once they come to an end, what's in store for the global economy? The other issue is that banks remain quite stressed. Now, central banks have basically averted a financial crisis, but banks still have to write off considerable amounts of debt. The IMF, in its latest report, estimates that about $2.3 trillion are going to have to be written off by banks over the 2008 to 2010 period, of which 2/3 of write-offs have already been realized, but we've still got about 1/3 of that to be written off. So banks remain quite stressed, they're unwilling to lend, and that's putting further pressure on corporates as well as consumers. So what we're expecting is a very mild recovery in the developed world this year. We're expecting overall growth to be about 3.9% this year, then softening to about 3.4% next year as the stimulus measures run out. Growth is really going to be led by the emerging world, which is sort of in stark contrast to previous periods when the emerging markets usually faced a lot of shocks, and the developed world sort of hummed along quite merrily. The imbalances that the developed world have really run up are going to act as a big curb on growth over the next few years. So looking at the developed economies and focusing on the US. Now, growth in the US was extremely strong in the fourth quarter of 2009. The US economy rebounded by 5.6%, but that's partly due to the statistical effects. Growth in the last quarter of 2008 was extremely low, so the rebound is partly from a very, very low base. The other thing is that if you look at the numbers, most of the growth, or 2/3 of the growth, was actually driven by this rebuilding of inventories. And that effect is going to peter out sort of from the third quarter of this year. In addition, consumers remain hesitant, and spending was up by about 1.6% in the fourth quarter. That, again, was driven primarily by government stimulus measures, which helped to support consumer spending. The reason why we're worried about growth in the US is because unemployment is extremely high. It's standing at a record high of about 9.7%, although that's slightly down from the December level of 10%. So the labor market is looking extremely weak, and unemployment is probably going to remain quite high in the future, because what corporates have found is that, they've reduced manpower, but productivity has actually increased. So they really don't have an incentive in the short term to rehire people. And the reason why that's an issue is that the US growth is primarily driven by the US consumer. About 70% of US growth traditionally is driven by private spending. So high unemployment is really going to act as a drag on private consumption. The other issue is the housing market. Now, it appeared sort of in the last few months of 2009 that house prices were beginning to recover, but they took another dive early this year. And it's likely that housing prices could potentially fall. They appear to have bottomed out a little at the moment, but there is quite a strong possibility that they could begin to fall again. The reason, again, why that's an issue is because about a quarter of US households are in a position of negative equity. So their loan-to-value ratios are actually terrible, because when they borrowed for their mortgages, that was their house prices were very, very inflated, and now they've been depressed, so they're in this position of negative equity. The reason why there's potentially more negative downward pressure on prices is due to several factors. One is that demand for housing has been artificially propped up by government stimulus measures, such as a tax credit for new home buyers. Now that's coming to an end at the end of April, so just in a few days' time. And once that ends, it's likely that demand is going to take a nosedive again. On the supply side, there's a huge amount of foreclosures stemming from very high unemployment, so that means that consumers can't make their mortgage repayments. In addition, you have a huge amount of housing stock on the market which needs to be sold. Banks are actually holding on to a lot of property, and they haven't brought that onto the market. And as more and more consumers potentially don't meet their payments, you're going to have this huge amount of housing stock on the market, which is again going to further depress prices. And that's going to have repercussions for the banking sector, which is going to have to potentially write off more bad debt, which is going to make it reluctant to lend on to consumers and businesses. And it's also going to have a further dampening effect on the US consumer, because they're going to have to save more rather than consume. So we're expecting the US to basically grow by a pretty robust 2.8% this year because of the restocking and the stimulus packages and loose monetary policy, but then a softening of growth to about 1.6% next year. The Eurozone is going to perform much worse than the US. So the Eurozone is expected to grow on average by about 1.1% in 2010 and 11. And the reason why we don't have such a buoyant recovery as the US is due to several factors. One is that fiscal stimulus measures were much less than in the US, and also the ECB was much slower to reduce interest rates and expand liquidity than the US was. So this sort of more tardy response is sort of pushing the Eurozone down. The other issue is that a lot of asset prices burst, or the bubbles burst over the last couple of years, particularly in places like Ireland, Spain, and the UK. The employment market is going to be another further dampening on the Eurozone in the next few years as well. This is because unemployment has been kept artificially low by various measures that governments have introduced over the last year. In Germany, for example, a lot of corporates were encouraged to keep employment steady in exchange for large government subsidies. But these measures are going to come to an end this year, and it's likely that corporates are going to let labour go simply because demand is not going to be very strong. The other issue is that the banking sector remains quite stressed because of the bursting of asset bubbles, and also because the EU has very, very strong exposure to Eastern Europe. A lot of the banks in Eastern Europe are owned by German or Austrian, Italian or Greek banks. And Eastern Europe was the worst emerging market region in terms of performance last year. Huge rise in non-performing loans, which are likely to continue to rise over the course of this year, and that's putting a lot of pressure on West European banks. So all these factors are going to act against a robust recovery in the EU. The other big issue is a lack of competitiveness amongst many countries in the EU. And this chart basically shows growth in real wages over the last few years. You can see Germany wage costs have been quite low over the last few years, whereas in some of the peripheral Eurozone countries which are experiencing problems at the moment, wage growth has been very, very fast. The reason for this is that a lot of countries basically pursued pro-cyclical policies during the boom years, and wage growth as a consequence was also very high. Germany did exactly the opposite. It basically reformed its labour market. It basically also reached agreements with trade unions and corporates to keep wages artificially low. So as a result, wages were kept very low. Germany was very competitive when it came to exports. But that's also had a bad effect on Germany because even though its fundamentals were very good running into the crisis of 2 years ago, everything was geared towards exports. So when the crisis hit and demand for Germany's exports basically shrank, then there was really no domestic demand, which took over as an engine of growth. So Germany basically contracted almost as much, if not more, than some of the other Eurozone countries with much worse fundamentals. The other sort of lack of competitiveness issues can be seen in current account imbalances. So Germany, because of its export-driven model of growth, has been running current account surpluses, while some of the peripheral Eurozone countries have been running quite massive current account deficits, although they did narrow last year. Now, in a sense, what's happening in the Eurozone is something similar to this great debate we have at the moment about China rebalancing and the US rebalancing. And this is something that the Eurozone is going to have to grapple with over the next few years. Now, unfortunately for the Eurozone, countries which are uncompetitive can't devalue their currencies in order to become more competitive. They have to undergo this process of internal devaluation, which basically means they have to make labour markets more flexible, and they have to cut wages. And that's going to be very, very politically unpopular. It's going to be extremely painful. And just to give you an example of that, the Baltic states, which are in Eastern Europe, which had their currencies pegged to the euro, have suffered, well, they overheated in the run-up to the crisis. And because they were very keen, and still are keen, on joining the euro, they decided that they didn't want to devalue their currencies because it would sort of put their euro accession plans in jeopardy. So they've been cutting sort of fiscal spending, and they've been cutting wages. And that's led to, for example, in the case of Latvia, the economy shrinking by over 20% over the last couple of years. So this attempt to sort of regain competitiveness is going to be extremely painful, and it's probably going to be extremely difficult for governments to push through with these measures because there's likely to be a lot of public resistance. And it may be the case that governments don't actually want to sort of push through with those in any case. The other big issue is that a lot of some of the smaller Eurozone countries have run up huge imbalances. And the focus of the last few months really has been on Greece because it probably has one of the worst fundamentals. Greece was targeting a budget deficit of 3% of GDP early last year. It's revised that estimate several times during the course of the year. A couple of months ago, it admitted that the deficit was likely to be 12.7% of GDP in 2009. But Eurostat issued a press release last week saying that the actual outturn was 13.6% of GDP, so absolutely phenomenally large. Added to that, you have the fact that public debt is about 120% of GDP, which is absolutely huge. And it's Greece has been cooking the books over the last few years, so nobody really trusts what they say. So, they've been fiddling with the accounting methodology. So the reason why it's becoming investors are sort of focusing so much on this is that, now that we're out of the crisis, and attention is shifting away from, the possibility of a huge major financial crisis, people's attention is now shifting towards sovereign risk because there's been this huge buildup of debt. And Greece has been pretty bad over the last few years, although people were sort of willing to ignore it because it was part of the Eurozone, so it was kind of cushioned, and there's really no currency risk once you're in the Eurozone. The issue with Greece is because it has such a high level of public debt, it also has a huge refinancing payments to be made over the next few years, and they're estimated at about 55 billion euros over the next 3 years each. So as investor sentiment sort of changed and attention focused on Greece, people began to worry about how it was going to cover all this. And, the cost of raising money on the capital markets began to increase. Indeed, I think today, bonds on 10-year Greek government bonds reached almost 10%. So there have been huge worries. Now, the EU has been very reluctant until recently, and there's still sort of misgivings about the EU's stance about extending a financing package to Greece. Primarily, this sort of pertains to Germany and France. They're both very worried about, extending money because they feel there's a moral hazard issue. If Greece feels that it's going to get, large chunks of money with no conditionality attached, then, they're just going to sort of keep on eating EU money. Greece, but anyway, because there's an issue with the stability of the euro, finally, the Germans and the EU in general agreed in the middle of April to a financing package of about 30 billion euros if the need arose. And the IMF agreed to extend about 15 billion euro in financing as well. Now, the Germans were kind of hoping that, just the offer of the money would be enough to stabilize the markets, because public opposition to giving any money to Greece is very high in Germany. The German public feels that because the Greeks retire at the age of 50, they're basically subsidizing the Greeks. So public, opposition is very, very high, and you can see this in the way sort of the German government is handling this. I mean, today Angela Merkel came out and said that, Germany was very willing to extend the money, but Greece had to come up with credible plans for the next couple of years in terms of meeting its budget deficit targets. And also there are a lot of people from the Balkans who work in Greece and send remittances home. So if Greece goes bust, then pretty much the Balkans go bust. And if Greek banks go bust, they own a lot of banks in the Balkans, like Romania and Bulgaria and Macedonia and Albania. So you have this huge knock-on effect on Eastern Europe. Closer to home for Greece, there's about 200 billion worth of Greek government bonds are held by foreigners. About 70 billion euros of which are held by EU banks, particularly when it comes to France and Germany. So if the Greek government goes bust, that again has a huge impact on the Eurozone and has the potential to really severely inhibit growth. Third worry is that if Greece does go bust, then what happens to the other peripheral Eurozone members? I mean, Spain and Ireland and Italy and Portugal are not looking very good either. Italy, to some extent, well, it has a very high debt level, but its fiscal deficit is slightly lower. And Italy is also kind of cushioned the way Japan is cushioned, in the sense that a lot of its debt, or the majority of its debt, is funded domestically. So it's more insulated. Portugal is looking vulnerable. It's got very high debt levels and also a very high fiscal deficit. It may sort of be cushioned a little by the fact that it hasn't, meddled with its accounting in the past, and it undertook a very credible austerity measures over the last few years aimed at bringing down the fiscal deficit to about 3% of GDP. So it's much more credible than Greece is. Spain is sort of in a slightly better position because its public debt levels remain very low. But Spain also needs to reform, and quickly, if it's to stave off a possible default. So things are not looking very good for the Eurozone, and there are huge risks that you have a very severe curtailment and growth in the short term. And this all raises questions about what is going to happen to the Eurozone. So what's the incentive for countries to stay? Well, if you have a lot of countries defaulting, you have a great lot of pressure on the euro. But if you're in the euro, you're kind of insulated from currency risk. Also, the costs of introducing a new currency are just going to be prohibitive. And the likelihood of a stronger economy leaving the Eurozone is very low. It's basically going to be a very vulnerable country that leaves, which simply won't be able to afford the administrative costs of introducing a new currency. So it's sort of not really probable at the moment, because again, if you do undertake the costs of leaving the Eurozone, your currency basically depreciates to the extent that it becomes worthless. Banks and government debt will basically be owned in a foreign currency, which would be the euro, and your borrowing costs will be prohibitive. So there really is no incentive to leave the Eurozone in the short term. Maybe in the medium to longer term, you may have some economies leaving the Eurozone simply because it will be easier for them to have a floating currency which they can devalue in order to become competitive. But at the moment, there just sort of isn't a chance of that happening. In any case, what the Eurozone is going to have to do is to come up with some sort of sensible way of forcing countries to adhere to the Stability and Growth Pact in order to keep the euro at least stable. So what's in store for emerging markets? Well, the performance of the recovery in emerging markets is really going to be determined to a great extent by what they were looking like in the run-up to the crisis. And so, for example, Asia is expected to rebound very, very strongly this year. And this is partly because it had very, very good fundamentals going into the financial crisis at the end of 2008. Now, the chart over here basically shows net external debt as a percentage of exports. And net external debt is basically your external foreign currency debt less foreign exchange reserves. You can see in Asia, foreign reserves basically exceeded external debt. In Latin America, it was falling quite rapidly over the last few years, although there's been a slight uptick last year because export growth basically was much more subdued or collapsed in some cases. So most emerging market regions took advantage of the boom years to introduce reforms, to prepay debt, to reduce public debt levels, and to also reduce fiscal deficits. So going into the crisis, a lot of countries could actually expand fiscal policy in order to support economies. This wasn't the case in Eastern Europe. So you can see private sector debt basically expanding at a merry pace in the run-up to the crisis. The sort of sharp shoot up in the last year is basically due to a complete collapse in exports. And also they were running very, very high current account deficits, although there has been a correction in the past year as both exports and imports shrank. So as a result, you had Eastern Europe posting the worst growth in 2009 compared with all the other major emerging market regions. And it's expected to have the most subdued recovery this year. So Eastern Europe was looking a lot like Asia did in the run-up to the 1998 crisis. Now, while Asia sort of learned lessons from that crisis and improved policies, Eastern Europe did exactly the same thing. So in the run-up to the crisis, Asia had very good government finances, it had very low private sector debt and very high savings levels. It also had been diversifying its trading partners, so it wasn't just primarily trading with Japan or the US or the Eurozone. There was a lot more intra-regional trade. There was a lot more trade with places like Latin America. And indeed, places like Brazil are rebounding very strongly because there's very strong demand from China for Brazil's commodities. In addition, because they were in such a strong position, they enacted huge fiscal stimulus programs. For example, China's fiscal stimulus package was much bigger than the US's. So they've been able to grow very fast. And just to give you an example, growth in Asia basically was 0.5% last year, and it's going to grow by quite a strong 4.7% this year. In Eastern Europe, in the run-up to the crisis, there were huge macro imbalances. For example, very large current account deficits. There was a huge expansion of credit as well, particularly to households, much of it in foreign currency. And for countries which didn't have pegs, there were huge currency depreciations, which basically increased the value of debt in local currency terms, which has put a huge pressure on the banking sector. Exchange rates were overvalued, which meant that they fell further in response to this basic correction that was happening. And Eastern Europe also was very, very hard hit by the slowdown in the Eurozone. The Eurozone shrank by 4% last year. And the East Europeans hadn't done a very good job of diversifying. So the collapse in demand in Western Europe really hit Eastern Europe hard. There was also very high reliance in countries which had better fundamentals, for example, the Czech Republic and Slovakia, which had very good fundamentals, and they basically pursued very prudent policies. Their economies basically shrank by more than 4% last year, and that was because they have this huge reliance on the auto sector, and auto demand was quite low last year, despite the introduction of cash for clunkers schemes in many countries in the Eurozone. Poland was the only country that averted a recession last year, actually posted positive growth, and that's because it has a much bigger internal market. So private consumption was quite buoyant. Again, Poland had stronger fundamentals, so it was actually able to introduce a fiscal stimulus package, and that really helped the economy. So as a result of all these imbalances and all these adjustments are taking place, Eastern Europe is going to be, again, the weakest performing emerging market region this year. This is because the recovery in the Eurozone is going to be extremely muted at about 1%. Banks remain stressed. NPLs are expected to rise to about 10% or more in many countries. If you look further east, in Ukraine and Russia, for example, NPLs could reach about 30%. So banks are remaining very stressed, very, very unwilling to lend on. Unemployment has risen to over 10% in many economies, so that's putting a lot of pressure on consumption. And again, many countries in Eastern Europe are forced to turn to the IMF for help. And relatively strict IMF conditionality is also putting pressure on their economies. By contrast, Asia is going to perform quite well, and that's really led primarily by China, which is expected to grow by about 9%, 9.7% this year, following an expansion of about 8.7% last year. Now, much of the growth in China has been boosted by this massive amount of lending. Lending increased by 33% of GDP last year, which represented a 31% year-on-year increase. This year, the target is for 7.5 trillion renminbi increase in lending, although the Chinese government authorities are basically trying to restrain lending because they're worried about the emergence of asset bubbles, particularly when it comes to the property markets. So they raised banks' reserve requirements twice in January and February this year. And there seems to be talk about introducing a property tax in order to cool the property market. This massive increase in bank lending is probably likely to result in an increase in bad loans in the future. We feel that that's not too much of a risk for the Chinese economy simply because the government has huge amounts of reserves. So they're going to be pretty easily able to bail out any banks that come under pressure, and they're not really going to expect the banks to repay that money. So, unlike in the developed world, I think it's going to be a more sort of benign outcome for China, and the Chinese authorities really are going to be, pull out the stops to avert any sort of crisis from occurring because they're very worried about the possibility of social unrest. So what are the risks to the outlook? Well, one big risk is whether the Asian economies are heading for a bubble. The reason why I'm focusing on this is that much of the recovery for the global economy is being driven by Asia. It's not just China, it's also the other developing Asian markets that are driving this recovery. And the issue is that if growth over there sort of stalls or turns negative, that's going to have implications for the wider regions. So as I said, a lot of countries in Latin America are benefiting from this huge sort of expansion in Asia. The issue for Asia is that it's importing monetary stimulus from the US. This is because many of them have de facto pegs to the US dollar, and monetary policy as a result is much too loose for these economies, which are growing much faster than the US is. As a result, there are worries about inflation, inflationary pressures building, and there are generally worries about asset prices, or bubbles being created. So the onus really is on a lot of Asian economies to start tightening monetary policy in order to prevent asset price bubbles from forming. Now, Malaysia's been the first country that's actually raised rates, along with Australia, which is a developed economy. But others should follow soon if they're to avoid the development of new imbalances. The other big issue is, and this is mainly for for the developed world, is when to sort of start tightening policy. If you do it too late, you might develop new bubbles. If you do it too soon, then you crush any recovery. So it's a very difficult balancing act to get the timing right and get to the extent of the timing right as well. You have also these huge sort of government imbalances that have built up, which need to be addressed. So what you probably will have is a case in which governments which are looking much more vulnerable and which have very, very high levels of debt, beginning to sort of tighten policy, especially fiscal policy, very soon in order to sort of stave off some sort of attack on them. Governments which are in much sounder positions can sort of afford to keep fiscal policy quite loose. And this is kind of essential because if you want to sort of have this fundamental rebalancing happen, then you need countries which have been sort of running consistent current account surpluses to begin to spend more. So you would want a country like China or Germany to actually keep fiscal policy slightly loose in an attempt to sort of boost internal demand, whereas countries like the US or some of the smaller European countries, you'd want them to sort of start tightening fiscal policy much sooner in order to sort of stabilize these economies and keep them on an even keel. So as I said, it's going to be very difficult for countries to get this right, and the danger is that if they choke off the recovery, then you won't have a slight softening in growth next year. You're going to have a double-dip recession. So it's kind of a crucial point. Looking at currencies, the dollar is sort of benefiting quite strongly from worries about Greece, for example, and that's expected to keep the US dollar at about 1.6 to the euro this year and next. The yen, which is also sort of is a safe haven like the dollar, has been strengthening quite rapidly. That's expected to be about 90 to the dollar over the next couple of years. But the worry is that if governments sort of fail to address imbalances and if they fail to reduce debt levels, then investors may lose faith. Now, the US benefits from the fact that it's the world's reserve currency, but over the last year, you've had countries like China, which are becoming sort of more outspoken when it comes to sort of developments, suggesting that there should be more than one reserve currency, maybe take up the IMF's SDR, which is a basket of currencies which comprise, the yen and the dollar and sterling and the euro. So if this is obviously more of a long-term risk. This is not going to happen anytime soon. But if you have this sort of discussion going on, and if the dollar loses its status as a reserve currency and it fails to sort of correct its imbalances, then you have potentially a run on the dollar, which would have horrendous consequences for the global economy. The other big issue is there are calls for China in particular to get the currency to appreciate, which would help to sort of reduce these global imbalances. The US sort of was initially taking a very strong tack, but it looks likely that the administration is sort of going to soften its approach because it realizes that being heavy-handed is probably going to act less as an incentive for China to actually go that way. In any case, we expect China to let the currency appreciate over the course of this year and next because it's keen to avoid these asset bubbles emerging, and it's also keen to dampen any sort of nascent inflationary pressures. So you are going to see some movement when it comes to the renminbi. So this is a picture for what the world looked like last year. And looking much more positive this year, but again, growth really being driven by China and India. The Middle East doing quite well on the back of higher oil prices. Latin America also benefiting from higher commodity prices. The developed world performing much more weakly because it's got more issues to work through, similar to Eastern Europe. And in conclusion, yes, things are looking much, much better, but it's important to keep in mind that a lot of this recovery is being driven by one-off factors like the inventory adjustment and fiscal and monetary stimulus. Emerging markets are going to sort of be the place to go, particularly in Asia, Latin America, and the Middle East. But Eastern Europe still weighed down by a lot of imbalances. Does anyone have any questions? Well, a lot of those loans are, particularly I think in the US and some of the Eurozone countries, are going sort of sour at the moment. And that's, again, going to put a lot of pressure on banks. It's also going to put a lot of pressure on the construction industry sector, which is going to act as a dampener on growth over the next few years. So it is a major issue. I think what the IMF sort of latest report has sort of included in its estimates for bank write-offs, sort of the number of the sort of commercial real estate write-offs. I'm not quite sure what the exact numbers are, but that 2.3 trillion figure really includes sort of write-offs when it comes to commercial property. But yeah, it really is going to act as a dampener on the construction industry.
This is being taped, so please wait for the microphone.
Hi, thank you. I recently read that the Chinese had no immediate plans to let their currency appreciate. So what makes you think they're going to do that, anytime in 2010?
Well, the Chinese government is sort of notoriously opaque about things, so it doesn't want to set a firm deadline because it wants to have some leeway. We feel it's going to have to do that because it's sort of inflationary pressures are beginning to build, and you have these sort of this property market bubble which is potentially emerging as well. And if you remember, a couple of years ago, the renminbi was actually allowed to appreciate by I think up to about 10%. Because you had this huge spike in inflation stemming from, the global food price crisis. So I think, there's a track record there, and the Chinese authorities will start letting the currency appreciate, probably quite moderately at first, because it wants to see exactly how exports respond. And once it's sure about what the impact is, then it's probably going to let it appreciate a little faster. But the timing, they're not going to set a set date for that happening. It's just, it will probably start occurring at some point this year. The other issue is, sort of, if you read the latest IMF report, what's interesting is what they say is you've had experience of sort of currencies being sort of adjusted, and this rebalancing occurring in many countries in the 70s before. So there's a precedent for this. And what they found was that sort of a currency revaluation really didn't have much an effect on growth. It wasn't statistically significant. Growth, there might have been a decimal point or two shaved off overall growth as a result of the revaluation. Now, what China would have to do is really boost spending on things like pensions and healthcare in order to provide a safety net for the Chinese, which will sort of help them become a bit more cautious about spending, because at the moment a lot of savings in Asia are being driven by the fact that there really aren't any social welfare nets. And once I think consumers have that sort of backstop, then they become much more confident and they begin to spend. And that will help the Chinese economy rebalance, because you'll have more of internal demand as an engine of growth and not just exports. Yeah.
You had mentioned several times that the banks are stressed and will remain stressed during the next couple of years. Is that correct?
Well, I think the US has done a much better job of writing off bad debt. I think they were sort of forced to more than they were in the Eurozone, for example. I think for example, German banks had a lot of exposure to toxic assets, and therefore, but they sort of they weren't really pressurized into sort of writing off debt. So it's sort of unclear about how much they have left to write off when it comes to that. But the issue is that I think U.S. banks are in a stronger position because they've been sort of adjusting for a longer period of time. They still have pressures from other sort of more retail, the retail side going sour. So you don't have just household residential property that's going bad as commercial real estate. You also have credit card loans and auto loans that are going sour. But I think the EU has even greater pressures because you have these bursting bubbles, which came much later than in the US. You also have this huge exposure to Eastern Europe, and the US doesn't have that external exposure the way West European banks have. So Eastern Europe is putting a great deal of pressure, and as I said, if Greece goes bust, then you have again a lot more pressure on West European banks. So as a result, because there's still a fair amount of uncertainty, then I think there's going to be some reluctance on the part of banks to extend credit.
As a follow-up, are you seeing now, or do you foresee any changes in global fractional reserve lending policies?
I would have to get back to you on that, I have to admit.
Thank you.
Hi there. What's the EIU's outlook on global commodities and especially Commonwealth resource extraction nations, Canada and Australia, both having burgeoning growth be like recoveries? How will those play into any kind of global recovery?
On commodities, what we expect, particularly for oil, we're expecting quite a robust recovery this year. So from about $62 a barrel for oil last year, oil prices are forecast to rise to about $77 a barrel. And that really is due to much higher demand from emerging markets in particular for commodities. And that's pretty much the story for commodities in general. You have China and India that are growing at a pretty steady tick. So, and sort of populations are becoming more affluent, which is driving demand for commodities in these countries. So while growth in sort of the developed world is expected to remain very subdued, you're going to have this very, very strong demand from a lot of emerging market regions, and that's going to cause commodities prices to rise quite rapidly. And you can already see that occurring because China is sort of demanding a lot of commodities from sub-Saharan Africa as well as Latin America, and that really is benefiting these economies because it's forcing commodity prices to rise. You'll probably see a slight softening next year because the global economy is expected to sort of soften a little because of these various pressures, particularly in the developed world.
Could you just make a few comments about Hungary and given the elections and what you see will happen there?
Well, that's a big question. The previous socialist-led government basically has been carrying out austerity measures since 2006. That was because Hungary ran up a deficit of just over 9% of GDP in 2006. Investor sort of sentiment sort of went very bad at that point. And Hungary was basically forced to implement quite tough measures in order to bring down the fiscal balances. So the fiscal deficit came in at about just below 4% last year as a result. Hungary was also forced to turn to the IMF at the end of 2008. It was one of the first countries in the world to do so in an attempt to sort of stave off a very severe crisis. The issue now is that a very populist centre-right government has been elected, which now has a 2/3 majority in parliament, which means that it's free to do pretty much whatever it likes. And the worry is Fidesz has sort of been saying over the last few months that it intends to sort of reverse a lot of the austerity measures that the previous government implemented, and it's going to pursue a pro-growth policy and not worry about austerity. Now, we're hoping that Fidesz is not going to do this, and we're basing this off the fact that Fidesz likes sort of catering to its domestic constituency. It says one thing to them, and then when it turns around to investors and says completely the opposite. But Fidesz has been in government in the past, and it was actually much more prudent than the socialists were. And it has a habit of just sort of political posturing in an attempt to sort of keep the public on its side. Fidesz sort of feels that the deficit this year is targeted at 3.8% of GDP. It's sort of been making noises that it could reach 7% of GDP under its leadership. Now, that would annoy the IMF horribly severely. It would also worry investors quite a lot. So it looks likely that the IMF, which in any case has been sort of pursuing much more moderate policies, in the sense that, the IMF hasn't sort of been as strict as it was in the past in terms of its conditionality, its loan conditionality. In the past May sort of agreed to a slight upward adjustment in the fiscal deficit. Now, if it does that, then I think markets will take this in their stride, because this had happened with Latvia last year. The economic recession was so severe that there was absolutely no way in which that Latvia could conceivably meet the targets that the IMF had initially envisaged. So there was sort of a collaborative process in which the budget deficit was revised upwards slightly, and markets were pretty sanguine about that. If Hungary does the same thing, then I think markets are going to be pretty sanguine, and there won't be huge implications for Hungary. The worry is that if Fidesz unilaterally loosens policy, then you have a situation in which it can't raise financing on the capital markets at all, and you have a huge crisis. But I think, on balance, you're going to have sort of a much more pragmatic government policy being pursued, because Fidesz really can't afford to alienate the IMF. It cannot afford to lose market confidence. And I think one telling sign is that in the sort of just before the election took place, Fidesz sort of turned around and said, started preparing the ground for, things not being as rosy as it had been promising in the past, saying that it had to deal with the mess the previous government created, and therefore the public shouldn't expect too much too soon. So Hungary may be okay, but, that there are huge risks.
We'll take 2 more questions.
What do you think the likelihood is that Germany gets off the euro and goes back to using the Deutsche Mark?
Pretty low. Because Germany was the biggest proponent of the single currency. I mean, this was its baby. This is what it dreamed up. This is what it's pushed for. For it to leave is just sort of it's a political defeat for it. I really don't think that's very likely. It would just be a humiliating retreat for it. And you can sort of see it in the way it sort of approached the whole IMF issue when it comes to Greece. Germany was horribly, horribly resistant to actually allowing Greece to go to the IMF in the first place, because it was kind of an admission of saying, well, the whole euro idea has been a failure. And it's only gradually come round to the idea because, there is no mechanism within the Eurozone to actually enforce the Stability and Growth Pact. So the IMF conditionality is going to sort of act as some sort of mechanism to force Greece to adhere to some sort of austerity package. So it's sort of very highly unlikely that Germany in the next few years is going to turn around and, turn its back on the euro.
Considering our current rate of unemployment, how would you grade our current administration's fiscal stimulus reaction to the past recession? And then I have a second one, which is, as a frequent attempted contributor to your letters section, what's the best way to get in there? Thanks.
Well, on the second, I'm assuming that you're talking about writing to The Economist. And we are kind of separate from The Economist. We're the sister group of the Economist magazine. So I don't have any ready answers for that, unfortunately. When it comes to the US, there really wasn't any choice but to implement a fiscal stimulus package. I think if the government had not done so, you really would be facing a Great Depression. I think research has shown that if you want to sort of stave off, a recession, or even, more pertinently, a depression, then you have to have fiscal and monetary policies working in tandem. You can't have one without the other. Monetary loosening was sufficient to sort of stabilize the financial markets. It wouldn't have been enough to boost consumer spending, improve consumer and corporate sentiment, and to keep sort of the economy from contracting more than it did last year. I mean, it already contracted by 3.4%. That would have been much, much more severe in the absence of a stimulus package. There wasn't anything else to do.
All right, well, I'd like to thank Leila Butt, the Economist Intelligence Unit. They'll stick around after and answer